Good afternoon. This is Laura McCabe. I'm the Director of Marketing. Daryl, can you maybe turn your camera off just briefly for me? Thank you, so people can see me. I'm the Director of Marketing for Sowell Management and the producer for the webinar series. So happy you're joining us today. I just want to go over a few housekeeping items, and then I'm going to turn the program over to Daryl, and he will introduce our full panel. So today's webinar will be recorded. It'll be available on demand with the registration link you used from Zoom, but we will also send out a Vimeo link via email probably tomorrow. We'd like to encourage you to ask questions. We'd like you to use either the Q&A window for that or the raise your hand. And raise your hand is, as you can imagine, like you're being called on to speak. The great thing about the Q&A is that it keeps track of all of the questions and can be generated out of reports. So if we don't get to your question, just know that someone will follow up with you. And with that being said, I'm going to turn it over to Daryl.
Thank you very much, Laura, and hello to everybody in our Sal Advisor community. We really appreciate every time that you choose to spend time to learn more about what we're up to at Sal, providing to you and to your clients. So I will introduce everybody today, and we'll kick it off. And we want to dive right in because we've got an excellent program today for everybody as we introduce our Sal Visionary Allocation Strategies, which is a collaboration between our Sal Ralliant OCIO office and Goldman Sachs Asset Management. So we've been working on this for many months, and you guys know I always talk about partnership. Our partnership first begins with you, our advisors, and we could not do everything that we do without our partnerships that we have. I always say we've been punching above our weight class, but that's because we have taken time and very intentionally invested in so many partnerships that drive what we're able to do. So just like you advocate for your clients, we're constantly every day advocating for you, the advisor, trying to provide tools that will help you be competitive, more competitive. We're always to help you stay on the cutting edge, save time, you name it, a number of things that we've talked about, and many of you have been with us for many years. So without further ado, I will launch into this, but I did want to say one entity that is not on this call, and I'm actually coming to you from Chicago today. Yesterday, Gary Taylor, who's our managing director of operations, and I spent an entire day with Geo Wealth, who you guys all know power our Flex Connect and our Flex IM platform. And they've been instrumental in a lot of things, but they were extremely instrumental in introducing us to Goldman Sachs Asset Management and some of the team members from Goldman that you will see here today. So I just wanted to give a shout out to them and a thanks for that partnership as they continue to innovate. And therefore, since we are a very important client of theirs, we get to benefit from their innovation as well and pass that along to you. So we do have today from Goldman, Chris Milliken. He is the head of Model Portfolio Strategy. He's going to address us first today. And then joining him is Tom Wood. Tom Wood is the VP of Wealth Customized Solutions. And we had a chance to spend some time with Tom at our recent investment management symposium in Laguna Beach, where he did a fantastic job. So Tom, it's really great to see you again here today. And then you all know, I think, at this point, Alex Shao, the ever-present Alex Shao. He's done amazing work with our advisors over the last 5.5 years as we've had our Sal Affinity team. So you guys probably know a little bit of change in the name. And that's because we also have now Ralliant in there, who we have that partnership with. Alex is both a part of Ralliant as well. And so you all know and love Alex, and I won't give a further introduction because you do. And Alex, we're so thankful for all the work that you've done with us over the years, and glad you could join us on the webinar today. Last but not least, I just want to introduce to you Jason Sue, excuse me, Dr. Jason Sue, but we all lovingly just call him Jason. But he is our resident superhero CIO, and we're very fortunate to have him on the webinar today. But he has been the co-founder of Research Affiliates. He is the founder and CIO of Rayliant, and we're very, very proud to have institutional grade partnerships that we can bring to you, our advisors, and therefore your clients, institutional grade portfolios that help do a number of things, but as you'll see in our Sal Visionary allocation strategies. So without further ado, and with that being said, I will turn it over to you, Chris, so you can share more about the strategies. We can dive into it. We will have a panel discussion with everybody here on the webinar. And then we always, as we always do, we want to make sure that we allow time for a Q&A from all of the participants that are on the call here. And so please make sure any questions you have that you'll have a chance to direct those. We want you to get those out. We love for that part to be conversational for sure. So with that being said, Chris, I'll turn it over to you.
Excellent. Thank you, Daryl. And thanks again, everyone, for joining us here today. This is a tremendously exciting day for us here at Goldman Sachs Asset Management. It's been a wonderful opportunity over the past couple of months to partner with Sal and all the folks on the call here as we've developed a suite of strategies that are custom built and exclusively available to Sal advisors. Daryl had mentioned our relationship with GeoWealth. That's another wonderful partner of ours, and we're excited to be able to work with both GeoWealth and Sal as we deliver these strategies to you all in a very efficient way. Quick background on where we sit within our asset management franchise. We represent our multi-asset solutions business, which is a part of our firm that has a 30-year legacy of working with some of the world's largest and most sophisticated institutional investors. And what we're really excited about as we look forward is our partnerships with some of the leading RIAs and taking that institutional framework that our multi-asset team has built over a series of over 3 decades and deliver that to financial advisors and RIAs via relationships just like this with these custom model portfolios. So we're going to talk through a little bit about the actual portfolios themselves and then have a panel discussion on how you should think about allocating to these as part of your practice. And so without further ado, let me turn it over to my partner here, Tom Wood, to talk through the strategies that are available to you today and how we've thought about constructing them.
Thank you, Chris. Welcome, everybody, and I'll add my excitement both to the launch and then the ongoing partnership, since this is just the beginning. And I am going to go into some detail around the models, but before I do, let me just say, what is this all about? This is about 3 things that Goldman is trying to help large RIAs solve. First, scaling their portfolio management, generally not replacing OCIOs, but helping augment them, competing for high net worth clients, and accelerating business growth. So I will jump into the details around the models, but just to make sure we're all clear on the headline and what is this all about. Let me start with a little bit around the who in the how. We're here today representing not just Goldman Sachs Asset Management, but the multi-asset solutions team, which, by the way, is the largest institutional OCIO in the country. We have a unified team and process. I don't know of any other asset manager that is running wealth models with the same team that manages pension funds for their largest corporate clients. But that's what we do. Whatever we're doing for our very largest clients, whether it's going up in quality, reducing duration, leaning into the US, even though some of the rest of investors don't seem to want to head in that direction. Whatever we're doing for them, we are delivering through our models, at least as possible. And that's certainly true of the Sowell Visionary Allocation Suite. Let me talk a little bit about how we manage things. There's a line here halfway down the page, three-phase active investment process. This is all about a disciplined approach to risk-taking. And part of that discipline is to separate our investment process into three phases. They're strategic. What are our long-term beliefs that rise above where we are in the cycle? What are we doing dynamically? How are we looking at the cycle? How are we looking at current risks and incorporating that into the models? And then finally, implementation, which is largely about vehicles and manager selection. Very important in this case in terms of the way that we've partnered with Brilliant OCIO to design these. Let me start with a few words on our strategic framework, which is really built on an understanding of why investors can expect to make money. The technical jargon would be, and I think it's even listed on the page here, that we have a framework that's built around risk factors rather than asset classes, but it's really all about an understanding of the why. If we're helping to finance corporate growth, that's a good reason that investors should expect to make money over time. If we're lending money for a longer term, we expect to be compensated for having the funds locked up in terms of lending. There are opportunities to take advantage of investor behavior biases. Some of their long-standing investment anomalies, such as momentum and carry that investors avoid because they come with risk. Those are the whys behind our strategic approach. If it sounds like we are pro-risk, then you're right. It's because it's through risk-taking that investors can expect to make money. What we're trying to do is do it in a disciplined as manner as possible. And here's your first little nugget to take away. On average, we tend to overweight stocks. If there is a model with a benchmark of 60-40, we're not going to average 60% stocks, or that's not been our historical average. It's closer to 62-63%. If we get the risk-taking right, your end clients are going to do better. Dynamic allocation, this is where you'll notice most of the changes in the models over time. This is where we consider the current macroeconomic environment, what we see in markets, policy shifts, policy risk, and then translate that into changes in the model portfolio allocations. We're very data-driven. We look at data across fundamentals, across sentiment, across technicals, across positioning. Coming into the beginning of the second quarter, for example, we noticed that the world was what we called limit long $1. It was the most consensus of all consensus trades. And of course, things have gone the other way, as you all know. So it's very important to us to look at a lot of data, but also to blend that with judgment. You notice that we call out that there's 300 investment professionals across the multi-asset team. And again, this is a unified team with a unified process. So we blend the data with judgment and then make determinations about how to adjust the portfolios over time. Our most recent adjustment was to lean into equities shortly after Liberation Day. So that's an example of the type of trade that we've made and something that so far has worked out for users of our models. Finally, implementation, again, that's about vehicles and managers. In this case, we've really leaned into ETFs and SMAs, both for their cost and tax efficiency of those vehicles. And what's really unique about the Sowell Visionary Suite is the blend of GS or Goldman Sachs and Brilliant ETFs. These models are custom to Sowell. They'll never be available outside of Sowell. And why don't we take a quick look at some of them now. Ultimately, we'll have 4 suites. We've gone live with 3 now, a 4th to come in the fall. For all of these, just to be clear, Goldman Sachs is managing the asset allocation. None of the models have a strategist fee. All of the models are blends of Goldman Sachs and Brilliant ETFs with a little bit of third-party product included as well. Sowell Visionary Allocation is likely to be used in qualified or IRAs. The fixed income is taxable. The minimum is only $25,000. Sowell Visionary Tax Aware, those would likely be used outside of qualified accounts where we've incorporated municipals into the mix. And then finally, the Visionary Allocation High Net Worth. This is the first model that we're launching here that includes an SMA alongside the ETFs that are part of that model, but all delivered as part of the UMA. So the stock SMA and the individual ETFs can all be implemented in a single account. We can talk about that more in the panel. You see that all of the models are going to have roughly 20 or so line items. All of them can be expected to trade about 4 to 6 times per year. Again, no strategist fees, and you see the expense ratios on the funds that comprise the portfolios below. We found that number of securities and that cadence of trading really helps us thread the needle and provide a good sweet spot in terms of giving you things that you can talk about with your clients, but not overdoing it. Let me say a couple things about some of the supporting services. All of the models will come with trade alerts. The initial trade alerts were done to announce the launch. They're all co-branded. You see the Sowell logo up on the top right, and the phrase "built with Goldman Sachs" up on the top left. As markets evolve, dynamic allocations change. Anytime that happens, a new trade alert would come out, and they'll look something like this. And they will update you and your clients with changes in the asset allocation. Something similar for the tax aware. Again, the primary difference between the visionary allocation and the visionary allocation tax aware is the use of municipals. And then finally, this is the portfolio that I'm referring to with the higher minimum, the Sowell Visionary Allocation High Net Worth model portfolio. This includes an allocation to an equity SMA. I've highlighted it right here, the Goldman Sachs Fundamental Equity Enhanced Core Equity SMA. So again, part of the supporting services are the trade alerts that advisors will get anytime the model portfolios has changed. There are also quarterly commentaries. And then finally, something that we put out on a periodic basis. You should probably expect something at least on the order of monthly that we refer to as desk notes. So anytime there's something meaningful happening in the market, there's certainly a lot of meaningful things been happening in the market recently. Doesn't mean that we're trading, just means we're putting out a bulletin on what's taken place, how we're looking at it, and give you some communication points that you can take to your clients. Just to briefly front run what we intend to launch later this fall will be a fourth model portfolio, tentatively called the Sowell Visionary Allocation Ultra High Net Worth. This will be a first in-market portfolio that has ETFs, direct indexing, municipal SMA strategy, and potentially even private markets and investments as well. All implementable in a single account on your FlexConnect platform. Last thing I'll say, I know we want to really spend some time talking through this a bit more conversationally. Just what do I think the key selling points are here? This is very innovative. Blending, and I won't take away from Dr. Shu, who's going to be able to weave in some comments on the Ralliant strategies, but blending the stock selection that's embedded in those ETFs with the asset allocation insights coming from Goldman, very innovative, not done anywhere else, very differentiated in terms of a model portfolio offering. Again, these models are exclusive to Sowell. Any of you who are bringing this to market, some of these strategies, particularly the ones that include SMAs, first to market, not just for these particular models, but even this type of model. And finally, just exceptionally cost effective. We really put a fine eye to the expense of the solutions that are used in the mix. And again, there's no strategist fee for any of the model portfolios. So I think with that, we're going to transition to the panel part of the discussion.
Yes. Thank you so much, Tom. That was a great overview. Now to continue to dive down into that further, I'd just like to ask everybody some questions here. And Jason, I would love to start with you and as the primary, and then of course everyone else can jump in. But the first question I really have is if you think about Rayliant and Goldman Sachs, they both have proprietary methodologies. So how would you translate the different approaches into a compelling message that resonates with clients?
Well, Daryl, before I get started, maybe we can unshare the compliance disclosure from the screen so we can see you.
I am happy to take that down. So yeah.
Also, as Thomas so eloquently shared, right, there are really two layers of very important, portfolio management alpha that you get in the product. At the asset allocation level done by Goldman, you have the dynamic asset allocation alpha that drives the long-term and short-term return of the portfolio. But within that portfolio, that's where Rayliant comes in, you have our multi-factor with machine learning anchoring the ETFs that will give you exposure to the different equity asset classes. And so that's another layer of alpha that gets created. So alpha on alpha by two best-in-class managers, that's incredibly compelling, and I think it's an easy message to sell. Now, if we focus in on how Rayliant does it, right? Let me start with the benefits. Of course, the benefit to the client is not only are you getting very efficient access to the different sort of equity markets, but you're accessing them where there are market inefficiencies, long-term source of premium. So you're getting a bit more, right? You're getting more return on top, which is the market access. That's the benefit. And how does that happen? Why should you believe in that? First of all, it is scientific. Right? If you read all the research on the best way to get access to markets, right? The multi-factor approach, that's incredibly scientific. It's very academic. And it is what all the institutions do, right? As Thomas mentioned, both Goldman and Rayliant are primarily institutional money managers. So Rayliant have run the same thing for different pension funds and endowments, foundations, sovereign wealth funds. The multi-factor approach is what institutions do to access markets, right? So you earn additional return through a very academic, institutional, scientific, multi-factor approach. And again, some of the most advanced advisors already understand that. They've heard that before. And this is, I think, that ideal implementation.
That's great, Jason. Tom, did you have anything that you would like to add onto that?
Yeah, just that, well, I agree absolutely with how Jason is putting it. This is a very institutional approach. It's really very unusual that an RA would be able to bring that to an end client all on their own. I'm not trying to pick on other asset managers, but a lot of them have their roots as stock pickers. So if asset manager A, who's a stock picker, wants to partner on developing something who's with asset manager B, who's also a stock picker, they're putting together two competencies that aren't really very complementary. And what's so beautiful about this is not only do you have the institutional background on thinking of decades of research around multi-asset risk factors and using that to drive asset allocation, the IP around security selection that Dr. Xu and Railian are bringing to the table, to actually weave that all together into some model portfolios for wealth clients. That's very, very unusual for an end client to be able to access something that's not getting an either or, right? I either get inputs from a premier allocator or a stock picker. We're putting it together in a both and context.
That's great. Yeah, thank you. I like there's things that you both hit on, but one of the things that we've thought a lot about is how to incorporate the story, so to speak, right? In other words, helping you as advisors, you're so great at communicating with your clients, but just making sure that we give you that story that goes with it so that you're able to clearly communicate a really sophisticated, allocation strategy here that is institutional grade. And so I like a lot of those things that you said there. I did, on that same note, I did want to bring you in, Alex, for the next question, just to make sure, because you've worked with so many of our advisors. And I know you hear this. Many advisors know they should use more scalable resources such as models, like we're talking about here, but have a hard time getting started. So, how can these models help with that scenario for advisors?
Yeah, great question. Every advisor has different reasons for, call it, not using sort of a scalable model. But we like to think of it as, we try to address it in three ways. But I think the most important takeaway is, are these models differentiatable? And so when we say differentiatable, we look at sort of three major considerations. One is cost of the models. The second would be nimbleness of the model, which I'll get into. And then the third would be brand. And so starting with cost, which you've talked about already, but maybe dig a little deeper. One is these models have no strategist fee. And so advisors are always concerned about fees. But what's also important with the fact that there's no strategist fee is it also creates administrative efficiency on billing. Because when you think about strategist fee, there's another layer of fees. And so by not having those fees, that all goes away. And to some extent, it makes it easier for billing for the advisor and for the client. Nimbleness of the portfolio, I'd say, is a couple of things of what makes this offering unique. Is a lot of the models don't necessarily have what we would call the institutional quality discipline that you would oftentimes see in more of the ubiquitous platforms. And so these models, with the help of Rayliant as well as Goldman, allow for a lot of those institutional disciplines and behaviors that you would want in a portfolio, which Tom kind of highlighted a bit already. And we're more than happy to talk about over time. The third also is important, I think, for an advisor, is the brand. And what brand is not just important, obviously, with Goldman and what they bring to the table, but it's also what underlies that brand is credibility and institutional discipline. And so I think with what Tom just said earlier is that what makes Goldman unique is they're not just offering institutional quality for their institutional clients, but they're making it available through their funds and ETFs, and the same for Rayliant. So I think those are the three most important things that we can address for an advisor to adopt models.
That's great. So many great tips there. Kind of continuing on that theme, and I'm going to direct this to Jason and Alex, so we can kind of continue down this path. But if you think about the theme of resistance to models, maybe, for lack of better words to say that, but do models have to be all or nothing? What are some creative ways advisors can personalize for individual clients, but get the benefits of scale? If that makes sense. Jason, you want to tackle that first?
Sure. So I'm only going to tackle part of that question and leave the harder part to Alex. I'm going to talk about resistance to model. And I'm going to use a football analogy, right? So I know a lot of advisors have resistance to model because they themselves are investors, right? They may have started off as a stock picker coming out of a broker dealer, and so there's some attachment to that. But I think there is that mental image of being the quarterback, right? And if you're an amazing quarterback, you invest well, you win the game. I'm going to challenge advisors who have resistance to outsourcing, who have that need to be the quarterback, to say no. To win the game for your clients, you want to be the GM, right? When you see yourself as a GM, then you can release and say, I want to hire the best quarterback. And that might be a model. That might be a few models, right? I want to have the best wide receivers out there. And I got to focus on trainer, coaching staff, dietitian. That is how you win consistently. So I think let go of the fear that if you don't have the glory of being the quarterback, that you'll do the job less well, right? That's a lot of ego, right? You do the job well when you step back and be the GM. So that's my sort of biggest suggestion and recommendation to anyone who has a resistance to this outsourcing of the in investment management. And just trust that your clients love you, not because you're a great quarterback. They love you because they trust you, and they trust you will find the best route to win every Sunday for them.
Yeah, that's good. Alex, I mean, you've been helping advisors do this every day here, at least with us for the last 5.5 years. Can you kind of speak to that as well?
Yeah, I'll just sort of segue a little bit from similar to what Jason described. What he's referring to is control and whether advisors feel like they're losing control. And to that extent, what I'd say is no, the advisor has total control of the portfolio. It's just what are we each good at, right? If you think about, are we good at stock picking? Is everybody great at stock picking, picking bonds? And so what you're letting go is not control, you're just letting go of and allowing the institutional sort of domain expertise to preside within their expertise, so to speak. So to that extent, though, I'd say, where does the advisor have control? And I think a lot of the times it's often driven by thinking that these are, as you said earlier, these are boilerplates. They're not customizable. They're very customizable, just in different ways. So when you think about the visionary fund models, can they be utilized in different ways? The answer is yes. They can be blended actually with existing accounts and holdings. That's number one. Oftentimes, and we'll probably talk about this later, is there are implications oftentimes of taxes on why an advisor cannot move from one place to the other. And there are solutions for that. But more importantly, the understanding is they can be blended. They can also be blended with whatever model they had before. It's not just about legacy holdings, but can they be blended with existing models that they have? Can they be blended with Sowell models even? Our home office model? The absolute is yes. Some advisor might even be concerned about brand in a different way. Can they be private label to some extent? Absolutely, through the element of blending them with other products. Customization is definitely a solution there. And so we just encourage advisors not to think about the fact of you're letting go of control is you don't have choice. As Tom alluded to, there are many variations in risk models associated with it. It's not just one model for all. There are different risk profiles and models that are designed for certain types of clients and certain types of objectives. But one of the key things and great things about these models is it has the client and advisor in mind, where they are designed for, again, different from the ubiquitous model that you can buy elsewhere. They are designed for certain types of clients and certain types of needs.
You mentioned transitioning maybe positions that have highly appreciated stocks in there, and I know that's a really important subject. I was just working on it yesterday, but I'll kind of direct this to Tom and to you, Alex. But on that thought, how are you mitigating the impact of taxes, both in terms of transitioning in client assets, and then of course in managing the models? I think there's kind of two elements to that. So maybe if you guys can address that a bit, that'd be great. And I'll chime in at the end with my own personal experience.
Well, so first, let me talk about what's available to you through the Flex Connect platform with regards to transition. On transition in, there's the notion of what we call taxable equivalence. So if there is a highly appreciated position, but it actually corresponds to something that's in the model, that's fine. The system is set up to be able to writ large transfer the account in without forcing a gain that is unnecessary. There's also a very new feature that should be available to all of you in terms of tax loss harvesting. So it's not just about avoiding gains on the way in, but it's what can we do to create tax efficiencies going forward. So Flex Connect itself is giving you some tax boost right out of the gate. Over and above that, from the standpoint of the models, I mean, the first thing is to not overtrade. I said it at the beginning, but we found that 4 to 6 times a year is about the right cadence to do what you need to do with the portfolios, give the advisor the right number of touch points with clients, but also not overdo it, not try to trade too much at any one of those points in times, and not try to do it too often. We've tried to choose very tax efficient vehicles. So there's not an actively managed, there's not even a passively managed mutual fund in the mix, but we've stuck to exchange traded funds and separately managed accounts. And then finally, the use of municipals in the tax-aware account.
It's great. Alex, I don't know if you had anything. I know you've helped advisors with this, but maybe you can add in as well.
Yeah, I'll add a couple of other dimensions to it. Obviously, with these models being predominantly ETFs, they themselves are fairly, call it, tax efficient, unlike the use of mutual funds. And so keep that in mind. But at the same time, our team is here, as Tom alluded to, with the Flex platform and now these new offerings available. The Sowell OCIO team is available here to work with advisors to deal with custom needs, because a lot of these accounts obviously are a bit more tailored in terms of their capital gains. But going into that a bit in the Flex platform, there's not only tax management capability that can be automated as an overlay, but there's also tax transition. And so those are all important. Those are very distinct offerings. And so as a client or advisor has certain elements that they need for a certain type of client, we encourage you to reach out to us and we can work out a transition plan, because oftentimes that involves a need to determine what's the right appropriate tax budget to transition an account, because it does take time. But one thing for sure is we will not flip an account immediately into model and not take that into account as part of that process. So that's what makes our effort a high touch offering. The last I'll touch on, and this goes more into some of the individual offerings, is not only the ETFs and tax management, but there's also direct indexing capability as well. And those all take into account tax managed solutions as part of the transition.
Yeah, you both hit on what I was hoping that you would. I was actually allocating a client account yesterday, and they had 100,000 of gains in there, and using the tax equivalent tool within Flex, we were able to get that down and start positioning right to this model to about 10,000 in gains that the clients would experience. So that those tools are there. We just wanted to make sure that you all were all aware of that. I just have a couple more questions real quick because I want to make sure we get to advisor questions. But I mentioned partnerships at the top of this webinar. It's extremely important to our work again with you, the advisor, but also in terms of what we're able to do. I think you can see that coming forth in this. But I want to direct this primarily to Jason and to Tom. But how would you talk about the partnership with Sal Ralliant and Goldman to a client?
So Daryl, I'm a big believer in partnership, right? There's that famous saying, if you want to go far, you go with the team, right? And look at the team here. You have Sal handling the platform, the technology, the operations. You got Goldman, one of the biggest model strategists that's institutional and have the scale, and now offering that asset allocation to advisors. And then you have Raylian, the pioneer in smart beta, the originator of the multi-factor IP. And this is really partnership of the very best in class available to an advisor. And for the first time, I think that kind of institutional quality available to advisors. And that's just unbelievably exciting. And then I think that's the kind of partnership you want to go far and to win.
Daryl, I draw an analogy to what Jason and Alex just talked about a few minutes ago regarding letting go of trying to control everything and do what you do best. And in this case, Goldman Sachs is going to focus on driving the asset allocation. Ralliant is focusing on security selection. And Sal, of course, controls the platform and know your client. And in some sense, you might, if you want to use the term outsourcing, we're kind of outsourcing these responsibilities to one another in a way, but in a partnership context to do so that we can each focus on what we do best. And yet at the same time, there's some common threads that really draw us together. Jason talked about the scientific approach to investing, which is true on both sides. And I think we're all very much client first, client first. And Alex touched on this too. We're very excited about making these models available to your advisors and your advisors and clients, but it's got to be a client first thing, right offering to the right client.
Yeah, for sure. I mean, obviously around Sal, we've talked about freedom for a long time, and of course we're in the independent space, and we love the fiercely independent advisor. We've started shifting our definition of that a little bit because we also do the same thing. We say, look, we're outsourcing for freedom. In other words, we outsource the things, right, that we know can be done either better or can be done at a reasonable price, and that frees us up, right, to continue to pursue other value creation for advisors. So I love that you hit on that as well. One last question for the panel here. Everybody, it's potpourri. You all can jump in at will, but what's an investment theme in the models right now that might interest a client? Who
All right,
wants to
I'll
go
go
first?
first.
Yes.
I'll go first, right? So I've been studying Japan because as macroeconomist is super, super exciting, interesting. They have been bad for 30 years. Why is it due, right? And this is kind of the headline. Japan is due. Because after 30 years is special because 30 years is the mortgage that Japanese households have locked themselves into at the height of the real estate bubble. And in Japan, you can't just declare bankruptcy and walk away. So they've been paying mortgage 30 years, right? Every penny they save goes to servicing that mortgage, and they're done. They're debt free, and all of a sudden, enormous disposable income. And so they're spending, inflation. It's a healthy, positive inflation coming back. Interest rates rising, so now there's positive interest rate on the big savings that they've accumulated, and now they can spend that interest rate. So virtuous cycle of positive spending. So I only expect great things to come.
I love that. Love that. From our end, I'll say we remain constructive on U.S. growth. And there's a theme with some investors out there that U.S. exceptionalism is over and it's time to head for the hills and put your money elsewhere. We're not there. We're not there yet. All these views are subject to change, of course, but for the moment, that's how we're leaning.
What I like to add is differently from an investment theme is it's an investment structure, so to speak, in a different way, which is one of the things you'll notice in the models is there's a bigger representation of active strategies led by sort of quantitative factors, as smart beta they like to call it, or Goldman likes to call active beta. That's important in this way as we look at models, and given our years of experience building models, is and what makes it very differentiated from the ubiquitous brand is you got to remember that the evolution of ETFs started with indexes and passive investing. And if you look at a lot of these models, you might think of differentiation by just the number of holdings. And we encourage any advisor and client to look at all the ETFs in the model. And if you look at some of those ubiquitous platforms, one of the common things from an investment perspective as a portfolio manager that we think about is overlap. Do you really have diversification with 15, 20, 30 ETFs? When at the end of the day, if you look at names like Apple and Meta and all that, they're in all the funds. And so we look at it from an institutional quality, is it really risk diversified? And so from that standpoint, what makes this platform unique is it actually has the ability to deconstruct risk, we say, and actually focus on targeted exposures and dedicated exposures. And that what makes this institutional quality. Because if you think about large institutions and they have SMA products that they hired Mike Goldman for or even Rayliant for, is they're really focused on targeted and dedicated exposures we would call basis risk in a certain way. And this doesn't necessarily exist oftentimes in ETF models. But with smart beta and active, these portfolios have less overlap and more targeted exposures that you would want at any point in time.
That's great. We're running up against time, so I want to make sure if you have questions, please type them into the Q&A at the bottom of your screen there. There have been a few questions that have come in already, so as you guys are formulating those and putting them in, I'll just run through these. One of the questions, Tom, I think you can help us answer this. Will slides be sent out?
Yes, I'm going to forward those over to Laura as soon as we're done, and welcome to distribute them.
Perfect. And I want to make sure we get more questions in here, although we love all of our advisors in Oklahoma. And so far, all the questions are from Oklahoma. So, hey, Oklahoma's winning. We got another question here. It says, I'm not clear on what percent of stocks are included in the allocation high net worth. Tom?
So the top level asset class allocations are very similar from model to model, and that's important to us because we don't want advisors there's not a good rationale for it to be different for the most part. We want to make it easy for advisors to use. In terms of the equity SMA, the allocation ranges currently from 7% in the 40/60 up to just about, not quite 19% in the all equity model. But when we send over the materials, you'll be able to see that in your inbox.
Yeah, in addition to that, I would just add inside Flex, if you go to the Model Center and you click on models, and then you just type in visionary, all of these will come up in there, and all the characteristics are there available for you on all those as well. So another question here, will you be sending historical performance data?
Well, these are new models, so I don't believe we will.
Yeah, it's good. Let's see, another one. What are I know you hit on this, Tom, but this is another question. What are the fees associated with these models?
So in the materials that we'll send over, you'll get the weighted average expense ratio of the underlying product. There is no strategist fee for the models, not for any of them. No strategist fee.
Perfect. So there is 10 basis points, right, for access to Flex Investment Management, but that's it. Otherwise, and again, you'll see all this once you get in there as well. Let's see, one other question. Great question. I think I can handle this one. Where do I go to get more information? And that would be from Scott Dooley. Some of you, if you have not met him, he is our Managing Director of Investment Management. And we can certainly make sure that you get his contact info. He is actually a CFA himself and can certainly speak to these models as well as anything else on our platform. So,
And I am including his email and the follow-up that will come from the platform. So his email address will be included.
perfect. Well, I don't see any more questions, and I know we're up against the top of the hour here. So this has been a great discussion. There will be a lot more to come for sure. We're very excited about our partnership with Goldman Sachs Asset Management. And of course, I think you guys are starting to see the upgrades that we are gaining in our Sal Ralliant OCIO team. It is been enhanced. It's already been great, but now we're just taking it to a whole nother level with the resources, data, research, everything that we're gaining from the expanded Ralliant team there as well. And so more great things to come. Thanks for the great questions you all asked. Appreciate everybody's participation here on the panel. We appreciate you guys very much and your partnership. And with that being said, Laura, I think the final, I'll turn, oh, you're all done? Okay, good. Well, thanks everybody again for being part of our webinar today. More to come. Reach out to Scott Dooley, get into Flex Investment Management, the Model Center. You can access them there and execute these into client accounts. So have a great rest of your day, everybody.